Welcome to Talk Tickers. All right, today we're jumping right into the latest earnings call from Crane NXT. That's ticker CXT.
So here's the puzzle. Crane NXT actually beat expectations on both revenue and earnings. But the market's reaction, it was swift and it was negative. The stock dropped about 6% during the session. So what on earth happened? Let's dig in and find out. Okay, here's our game plan. We're going to look at the headline numbers, then we'll break down the performance of their two main divisions. We'll get into the guidance that clearly spooked investors, check out their long-term strategy, and then we'll wrap it all up with our take on what's next for the stock.
All right, first things first. The crucial point here is that, on paper, this was a really solid quarter.
And you can see it right here. This was a clean beat, no doubt about it. Adjusted EPS came in at $1.28, ahead of what analysts were looking for. And net sales, $445 million. That's not just a little bit of growth. That's a jump of over 10% from last year, blowing right past Wall Street's target. So far, so good, right? Well, this is where things get interesting. Because when you dig just one level deeper, you find a really sharp split in performance. And that tells the real story of what happened this quarter. Yeah, this chart just lays it all out. It's like a tale of two companies inside of one. You've got the Security and Authentication Technologies segment, we'll call it SAT. This is the part of the business that makes anti-counterfeiting stuff for banknotes. It absolutely exploded, surging over 28%. But then you have the Crane Payment Innovation segment, or CPI. This is your payment systems for things like vending machines and retail, and that part of the business, it actually went backwards, shrinking by almost 4%. So what was driving that incredible strength in the SAT business? Well, it was a bunch of things. A huge boom in countries modernizing their banknotes, a near-record backlog which gives them amazing visibility into the future, plus a nice contribution from that new Rue acquisition. The problem is, all of that fantastic news got completely overshadowed by the cyclical slump hitting the payments side of the house, especially in those vending and retail markets. Okay, and this is the turning point. This is the moment in the call that explains that big stock drop we saw. We're talking about management's updated forecast for the full year. And here's the paradox, the real head-scratcher. On one hand, management actually raised their sales growth forecast for the year. That's a huge sign of confidence, right? All thanks to that awesome momentum in the SAT business. But, and this is a big but, at the very same time, they tweaked their earnings forecast by cutting the top end of the range. That's a huge signal of caution about profitability, and it points directly at the weakness they're seeing in the CPI business. And of course, investors pounced on that. They completely zeroed in on that lowered earnings ceiling. For the market, the interpretation was clear. The short-term problems in the payments business were a bigger deal than the amazing growth story happening in security and authentication. So the big question is, what's management doing about this imbalance between the two segments? Well, their answer is pretty radical. They're fundamentally reshaping what Crane NXT even is. They have a super clear and frankly aggressive strategy. They're using major acquisitions to deliberately shrink their exposure to those cash-heavy markets. I mean, think about this. When the company first split off, 80% of its business was tied to cash. After these deals are done, they expect that to drop all the way down to just 60%. That's a massive shift. And this whole strategic shift is basically a two-step move. Step one was that Rue deal, which instantly beefed up their brand protection business. But step two, that's the even bigger move. It's the planned acquisition of Antares Vision. This is a game changer because it pushes Crane NXT right into the middle of the high-growth, regulation-heavy world of track and trace for things like pharmaceuticals and food. The whole idea is to make their earnings way more stable and less prone to these economic cycles over the long run. Okay, so with all of that as the backdrop, let's get into our take. Here's what we think comes next for Crane NXT. Look, in the short term, we expect this story to stay the same. Strong SAT versus a weak CPI. That record backlog in the SAT business gives them a ton of runway, which is great. But what we'll really be watching for are any signs that the weakness in CPI is finally hitting a bottom. And of course, the number one catalyst to keep an eye on is how well they execute on closing and then integrating that huge Antares acquisition.
So, because of this tug of war inside the company, we think the stock is probably going to be stuck in a range, probably in the low 60s. The market is basically in wait-and-see mode right now. It wants proof. It needs to see that those problems in the CPI business are fading before it's going to give the stock a higher valuation.
So, for the next call, we're kicking off our coverage with a market perform rating. Here's why. That long-term growth story in the SAT business, plus the really smart acquisitions they're making, that puts a pretty solid floor under the stock price. We don't see it collapsing.
But those cyclical headaches in the CPI business really put a ceiling on how high it can go in the near future.
And really, that's what it all boils down to. It leaves you, the investor, with a really interesting question. Do you bet on management's very compelling long-term vision, the strategic transformation? Or do you play it safe and wait on the sidelines until this storm in the payments business finally blows over?
This is not financial advice.